Hi guys, in the following I will show you how to draw a true order block and then refine that order block to factor in a little bit more information for maximum precision. Okay, now based on the previous theory, we're going to go ahead and show you an example, right? And we're going to take a look at this point of structure. So to have a valid order block, right, what do we need? We need a bullish or bearish break of structure, right? So what can we see here? Okay, we can see the highs over here, low created. Why? Because we have a break of structure here. Now, as price came back up here, we created equal highs, right? It didn't necessarily break the point of structure until price created a new low here and then impulse to the upside to break that market structure that we're looking at here, right? And this is based on type 1 market structure reading. That's the one that I use personally. Okay, now if you were looking at type 2, of course it would be slightly different, where your, let's put this back, where your break of structure would have happened, over here, right? So then this would have been another break of structure over here. Okay, so all in all, it would tell you pretty much the same thing. And what is it saying? This impulse here created a break of structure, so we have a point of interest or an order block to draw down there. Okay, so let's go and draw that order block. So based on the theory that we've seen, right, the true order block is based on the last sell candle. In this case, because it's a bullish order block, the last sell candle before the buys, right? Before the impulse that created imbalance or price inefficiency and extended to create a break of structure, right? So this is the break of structure that we have. Now, this over here, you see, is the true order block, yes. And how can we refine this order block to factor in more information for maximum precision? Okay, so the first thing we can do is, of course, factor in the wick lows, right? Because we know that that area could be an area where price, almost taps into and then moves to the upside. Okay, so we don't want to ignore this information. And if we are entering in this trade, for example, right, we don't want to get purged or stopped out of the trade. Okay, so first refinement here is to factor in the lows of this wick, right? So then this is your true order block with a little refinement to factor in the lower wicks of the actual order block, okay? And then the next refinement you can do within the same time frame is refine it to the next candle. And the reason behind this is because the true momentum, let me zoom in here. So the true momentum that created this level of demand or this bullish order block, right, originated once this big candle was created. So what did this happen, or what did this create? It created imbalance over here, right? And it broke above the top wick of our true order block right here, right? So it slightly broke above, right? So this doji candle here, or this refined order block, didn't really kick in with momentum, right? So we can draw it based on this. As long as the candle that you're drawing your order block didn't close above the true order block candle, then we can refine there. And in this case, we're factoring in, price inefficiency imbalance. Okay, let's make this a little bit smaller. Right, so we have imbalance here. Right, so we know that after an impulsive move to the upside, right, there's imbalance that's been created in the price, right? So price will come back, gravitate to these areas to rebalance the price or the market in general tap into our area of demand and then move up. Okay, so let's see how much of a difference, you know, this little refinement would do. So based on the theory we've seen, right, we can enter in two ways. We can either enter at the proximal point or the equilibrium. And in this case, what we'll do is we'll just assume that we're always entering on the proximal point of the order block, right? Just so we can see the difference between the true order blocks and the refinement. Okay, so an entry based on this example, right, would have been at the proximal point. Your stop loss would go 2 pips below, right, to factor in the spreads. So this is about 16 pips. So what I'll do is do 18 pips. Okay, and of course the trade would have ran at least to the previous highs, right? And then for it actually went all the way up to this point, you know, allowing you to potentially make 3.43 R, right? 3.43 risk to reward. So if you're risking 1% on this trade, right, you had a potential of 3.43% in rewards. Okay, whereas if you do factor in the refinement, right, to take into consideration where true momentum entered the market and where the imbalance lies, right? So we just use this candle here, right? We'll factor in the low of this candle as well. So this would be your refined order block within the same time frame. And notice how our entry is going to be lower, so much more precise, right? Giving us a smaller stop loss. Okay, this is 9 pips, so 2 pips below that would be 11 pips. And of course, to the previous highs, we had a 4.85 R, and all the way to the highs, this would have given us a potential of 6.18 R, or slightly a bit more, right? 6.32 R, compared to previously where it was slightly above 3 times our R. See? So we see that with this refinement, of course, there's pros and cons for it, right? It increases your risk to reward because you're entering with maximum precision. However, price could just tap, you know, in here, not tap into the refinement and then move up. So the disadvantage of that is that you may be prone to miss out on more trades. So in the next video, I'll be going through a live example. So I'm going to walk you through different order blocks and we'll break them down and have a little discussion about it.